Since I started this channel several months ago, I got several people commenting on my videos. A girl talking about investing. A girl talking about finance. What can she teach me? You want a girl talk about investing? Here you go. Do I look beautiful?
Yeah.
Why didn't you say it then?
Say what?
That I look beautiful.
I just did.
Only because I asked. So I'm going to mention the main terms that all beginner investors should know, but don't try to find any logic in the order of me mentioning different terms, because logic and women, they don't come together. So the first term is bears. Who are bears? You know, these furry animals, they can be brown, they can be white. Joking. Bears are those investors who think that the market will go down. They think that the price of stocks and shares will fall. So bears usually try to sell the stocks that they already have, or they open short sells. Opposite to bears, we have bulls. Bulls are those investors who think that the price of the shares will go up and that the market will continue to grow. Bulls will continue to buy the stock because they are sure that they will be able to sell it in the future for a higher price. The very simple explanation is that bulls are buying the shares and bears are selling their shares, because bulls think that the price will go up and the bears think that the price will go down. You may sometimes hear the phrase "I'm bullish on this stock." That means that I think that the price of this stock will go up. Or contrary to that, I'm bearish of this stock. That means that I think that the price of this stock will go down. You can also hear the phrases like "it's a bull market." It means it's a growing market. It means that even in the future the price of this stock will go up. Or you can hear it's the beginning of the bear market. The bear market means that the price of the stock will go down. You can be bearish or bullish towards only one company. For example, if you think that Tesla is going to grow, you're bullish. If you think that Tesla is going to fall, you are bearish. Or you can be bearish or bullish towards the whole market. If you think that there is going to be a crisis, an economical crisis in the whole world or in the whole sector, you can say that I'm bearish. In this case, you will most probably want to sell all of your assets off and wait till the price goes down, then buy everything back at the discounted price. Why these two animals are mentioned in the stock market is because of the way they attack their victim. Bears usually attack their victims by pressing them down to the ground, so they go down, and bulls are trying to put them onto their horns by pulling their head up, so they have this up movement. Therefore, when the market goes up, it's a bull market. It's pretty easy and pretty logical. So in the first explanation, I was talking a lot about the stock. So let's talk about what stock actually is. Stock in investing has a very similar meaning to the stock in the other aspects of life. For example, in retail, if you have a shop and you say that I need to buy more cheese because I'm out of stock, so you don't have any more cheese left. All the cheese that you have in your storage is your stock. It's the same here in investing. All the shares that you bought are your stock. And stock consists of many shares. So what is a share? A share in investing is a part of a company. It can be a very, very small part of the company. For example, if you buy a share of Coca-Cola, imagine how much Coca-Cola is worth altogether as a company and how much one share is worth. So by buying one share of Coca-Cola, you own a very small, a tiny bit of Coca-Cola, but you become a real owner of this company.
Yeah.
How does my hair look?
Beautiful.
Bond is a different type of an asset group which is not correlated to shares. And whilst shares, when you buy shares, you buy parts of companies. By buying bonds, you just lend your money to organizations. Organizations, on the other hand, take your money, use it, and promise to pay this money back after a certain time, plus some interest on top. That's why bonds generally are considered less risky than shares. Gilts in the UK is a different type of bonds where you lend your money to the government. I know it sounds a little bit strange, but the government does actually take your money, borrows your money, and uses it for whatever reason, for whatever purposes they want. Then, after several years, they pay you this money back and also some interest on top. Gilts are the least risky assets because when you lend your money to the government becomes your guarantor. So with the corporate bonds, when you lend your money to the company, if the company goes bankrupt, then it will be hard to get your money back, whilst with the government, the only way that you will not get your money back is if the whole country stops functioning, the whole country disappears, which pretty much is impossible. Therefore, you are almost guaranteed to get your money back. Another interesting term that you need to know if you are about to start investing, and the one that you can read here and there all the time, is a hedge. So what does hedging in investing means? Imagine, let's go back to the bears. Imagine that you are walking along the forest and you see a bear approaching you. What will you try to do? You will most probably try to hide yourself in a hedge, for example, on the side of the road. Then there is still a chance that the bear will see you and eat you or whatever, but there is less chance that the bear will see you in the hedge than if you were standing right in the middle of the road. Well, it's the same idea here in investing. Did you notice that the investing world definitely has this very strange and weird connection with bears, forests, bulls, animals, nature, and all that? Well, anyway, hedging in investing means a very similar thing. If you think that something bad is coming in the market, so for example, the market is going to fall, the crisis is approaching or something like that, you will try to reduce your risks of losses. And when you try to reduce this risk, you are hedging. This is what to hedge means. So basically, to hedge means to try do something about your portfolio to minimize the risks of losses. It may mean, for example, investing into a different company from a different sector, economical sector, or it may mean selling your shares. How does my hair look?
Beautiful.
There are certain type of organizations called hedge funds. So hedge funds come also connected to hedging. A hedge fund is an organization that everybody was trying to screw over by buying GameStop several months ago. So hedge funds are the organizations that are trying to protect themselves by using all the different techniques that all the beginner investors probably shouldn't use. So they may use leverage, short selling, all those kind of things. So in other words, they're all about CFDs. If you don't know what a CFD is, because CFD is more important than all these other terms, because on different platforms for beginner investors like eToro, like Trading212, you are allowed to use CFDs, and it is so easy to lose your money on CFDs that I thought it was a good idea to make a separate video for that. If you haven't watched it, I will attach the link below in the description box to this video, so watch it please, because CFD is really important and is really risky. But with CFDs, there are other terms that are very closely connected. So, for example, leverage. Leverage in investing is the same as mortgage in real life. By using leverage, you borrow the money from your broker to buy more shares or to buy bigger stock than what you can afford with your real money. So when you use leverage, you increase the risks, because every time something goes wrong and you start losing the money, you don't lose just the money that you invested, but you also lose the money that you borrowed. And also, when you borrow the money, so when you use leverage, you have to pay higher commissions to the broker, just like with normal banks. I also also mentioned the term short selling. So what are shorts? Shorts are not short trousers. Short selling in investing means that you think that the price of the stock will go down and you want to make profit on it as well. So short selling is very closely connected to CFDs. Short selling means that you basically sell the stock that you don't even own. So in other words, you make a bet that the price of certain stock will go down, and if it comes true and the price does actually go down, you make profit anyway, as if you held a real stock and you sold it just before the price started to decrease. All these actions when you try to sell the stock that you don't own are called short positions. And opposite to short positions, there are also long positions. Long positions are the bets or the purchases that you make when you think that the price is going up. Let's connect short and long positions to bears and bulls. If you are bearish on the market, you will most probably open a short position, whilst if you are bullish, you will most probably open a long position. Next important term is the compound interest. So if CFD was your enemy, if you didn't know what a CFD is and how to use it properly, then a compound interest is definitely your friend. A compound interest is your friend as a rule in general. A compound interest is the interest on your interest. For example, if you invest into companies that pay you dividends, and after receiving this dividend, you don't just keep these dividends as a cash, but you reinvest these dividends into the same companies, then the compound interest starts to work. And the effect that the compound interest has over your money is immense. I made another video about it as well because I find it so important, and it's definitely something that I wish I knew earlier and started using as soon as possible as well when I was much younger. That's why if you want to know more about what a compound interest is, then please watch another video. But basically, just in simple words, a compound interest is an interest on your interest. One more is a fund. What is a fund? Do you know how our parents used to think that investing is very risky because you had to buy the individual shares of individual companies, and if this company was struggling economically, the shares were going down and people were losing their money. So a fund is the way to diversify your portfolio in a very easy way, because by investing into a fund, you don't invest into just one company, but you invest into many companies straight away. The most famous and the most popular fund is S&P 500. It's a fund that invests your money into 500 biggest companies of the US. And by investing small amounts, you buy little fractions of shares of every big company in the US. So by doing this, you minimize the risk of having any losses at all. Because if one company out of this 500 has some problems, the other one will most probably grow, and so the balance will stay the same. S&P 500 on average grows with the speed of 7% per year. Try to find a cash ISA with the same return on investment. It is impossible. So if you aren't prepared to take high risks, then investing into funds is probably your best shot. And investing into a fund is possible nowadays almost on every platform. The most famous one for funds is probably Vanguard, but you can invest into funds through eToro, Trade212 or Free Trade as well. How does my hair look?
Beautiful.
Okay. And the last one for today is a blue chip company. So what is a blue chip company? All these 500 biggest companies that are included into S&P 500, they are called blue chip companies. So in other words, a blue chip company is the biggest company and probably the least risky one. So if you aren't sure about all the different companies that exist there and you don't know what company to invest in, again, if you are not prepared to take on high risks, then you want to invest into a blue chip company. You most probably know the majority of blue chip companies, you just didn't know that they are called blue chip companies. Amazon, Facebook, Tesla, Johnson & Johnson, and so on. All these companies are blue chip companies. So here we go, guys. This is the girl talking about investing for you and explaining you all the main investing terms in very simple words. If you don't understand this explanation, then I think it will be hard for you to find an easier one. If you don't know some other terms that you would like to understand and you would like me to explain to you, then please leave these words in the comment section below this video. For today, thank you very much, guys, for your attention and time. Bye bye.